Hello friends, today I'm going to teach you about the introduction to the financial management. This subject is very important from the point of view of the UGC, commerce as well as the management aspirants. So let's start the topic. First of all, we are going to see what is the meaning of finance. Finance in basic term is the money or the assets that are being purchased from the finance. However, financial management is concerned with taking the decisions of money, how the money is being procured, how the maximum returns are being taken from the finance, and so on and so forth. However, there is a difference between accounting and the financial management. Firstly, accounting is concerned with keeping the records. For example, you maintain the financial statements in terms of trading account, P&L and the balance sheet or any other financial statements. Accounting basically is concerned with the treatment of funds, how you treat the funds, whereas finance is concerned with the decision making. Whatever the data you extract from the accounting, you use it for the decision making. Hence, we can say that finance is a wider term than the accounting. It can also be said that the finance starts where the accounting ends. Now, the difference between accounting and the financial management, like I told you, that accounting is more about reporting the financial information to a particular individual or a business entity, whereas financial management is concerned with involving the finance, assets and resources. It takes part in the financial planning, control and the decision making. I hope you've understood the difference between accounting and the financial management. Now we can see that what is the scope of financial management. Financial management is basically concerned like how large should an enterprise be and how fast should it grow. Another aspect is in what form should it hold the assets and how much is the liabilities, and how to manage all these things is the scope of the financial management. Now these can be answered with the three major decisions of finance. First is the financial decision, first is the investment decision, then is the financing decision, and finally it's a dividend policy decision. We are going to discuss all these things in details. First is the investment decision. Investment decision is concerned with the selection of the asset in which the funds will be invested by the firm. Now these can be classified broadly into two categories. One is the long-term funds and another one is the short-term. Now long-term investment funds are called capital budgeting, whereas the short-term short-term investment decisions are called working capital management. Now if we see in long-term asset, that is financial budgeting, what do we need to see is basically concerned with the selection of the asset that is going to give us benefits for the upcoming years. That is not only concerned with one financial year but for more than one financial year, right? So in this we need to see what are the various risks and uncertainty being concerned. So since these are big decisions and the accruals are uncertain, so this is very important to take care of, right? Secondly, it is a short-term or the current assets, that is also known as working capital management. Working capital management in broad term is basically concerned with your current assets minus your current liabilities, right? Your current assets minus your current liabilities gives you the working capital. So for working capital, you need to see and you need to evaluate about both the profitability and the risk involved. Risk involved can be in terms of liquidity. So a trade-off needs to be maintained between both the profitability and the risk involved for the short-term assets. Further, we are going to see about the financing decisions. Financing decisions basically are concerned with you need to take the optimum decision with regards to your debt and your sources of financing decisions relate to the choice of proportion of your debt and equity source of financing. This is known as your capital budgeting. So as you know that for financing, the two major sources of finance are being available to you. One is your debt and another one is your equity, right? In debt, what is there is, irrespective of the fact that you have earned profit or not, you are supposed to pay the interest to the debt holders, right? However, in terms of equity, we give dividends only and only when we have profit, or the company finds it suitable to pay the dividend, right? So the trade-off needs to be maintained between the debt and the equity. See, for debt, it is the tax deductible, whereas equity share are not tax deductible. Hence, the trade-off needs to be maintained. Moreover, there is one another catch over here is like, in debt, what you have is, there is a fixed responsibility or the obligation of the firm to pay the interest, whereas in equity there is no fixed obligation to pay the dividends. Moving on, we have the dividends decisions. Now every firm earns profit, so it has two choices. Either it can distribute in the form of the dividends, or it can retain it in the business itself. Now what is the purpose of retaining the business, what is the purpose of retaining the dividend in the business itself is when it has the growth perspectives. Hence, a trade-off needs to be made whether the dividend needs to be distributed or it should be retained in the business. Further, moving on, now we have the objective of the financial management. There are two broad financial management objectives. One is profit maximization and the wealth maximization. Profit maximization was used earlier, and nowadays it is the wealth maximization that we use. Now, what is the difference? What are the pros and cons of using both the terms? You are going to discuss in the next lecture. And if you have liked this lecture, kindly subscribe to my channel. Thank you.